The S&P 500 hit its 39th all-time high, while the PSEi closed on a 52-week high. But I'm getting worried that the markets might have already gotten too greedy. Let's discuss. My name is Den Slim, and welcome to another episode of Monday Market Outlook. The big news last week was the surprise 50 basis point rate cut by the Fed, officially starting the easing cycle. And while the significant policy shift was widely expected, investors were surprised with the aggressive 50 basis points cut. But this move was embraced by investors after Chair Jerome Powell's message that the Federal Reserve made a big interest rate cut to support the economy and not to save it. He also said that the labor market is in solid condition. The intention of our policy move is actually to keep it there. We don't think we're behind policy. We think this is timely. You can take this as our commitment not to fall behind. Our economy is strong overall. Now, in summary, he argues that the move to cut the Fed's benchmark rate by 50 basis points was instead a way to try to ensure that the strength of the labor market and the economy can be maintained. So what's next for the Fed? Looking at the dot plot, projections for year-end is around 4.5%, further easing to 3.25% at the end of 2025. Revisiting our BSP timings, the U.S. federal funds rate now at 5%. So from the dot plot, this means two more 25 basis points cut are scheduled for the next two FOMC meetings to end the year at 4.5%. So the question here right now, will the BSP mirror the Fed's move on their October 17 Monetary Board meeting? Finance Secretary Ralph Recto hinted a similar move, but of course ultimately it will be the BSP Governor Remolona, who will decide. And as per Governor Remolona, during his previous interviews, Fed rate cut is just one of the data points they are looking at before making a decision. But in another move, the BSP has already announced a 250 basis point cut on the bank's reserve requirements by October 25. And of course, this will be good news for banks as they will have more earnings potential, and also good news for consumers as the influx of money supply should be able to help lending rates go down. Remember, the BSP can actually use other economic instruments to control the economy, and the reserve requirement is just one of them. Reducing the reserve requirements from 9.5% to 7% means that banks will have extra cash that they can put into revenue generating activities, which is why the banks had a solid week. BDO already had its run-up, but look at BPI and Metrobank, and look at the rotation into Union Bank, China Bank, Security Bank, RCBC. Congratulations if you're holding these stocks. But while the spotlight was on the banking sector last week, we also mentioned that aggressive rate cuts will have significant upside for the property sector. Looking at the comparative sector performance, the property sector has actually lagged in terms of the year-to-date performance, but has only recently started to make its move. Year-to-date sector performance is at 2.7% compared to the index at 11.7%. But starting June 21, the top performing sector in the index was the property sector. So think about this: reserve requirements going down, aggressive 50 basis point rate cut, and a potential 125 basis point further cuts into next year. This is a perfect storm for the properties and REITs to have more upside compared to other sectors in the index. So let's look at the PSEi charts. The PSEi tapped into the 7,300 resistance but ended Friday on a mark on close dip to 7,252. Actually, if you look at the 5-minute charts, the market was actually doing quite well before that mark on close happened, putting the markets below the 7,300 support. Now, at this point in the rally, this still looks like a third impulse wave. And if we plot an Elliott wave here, the first wave is here, the second corrective wave, third wave here. Is this the peak of the third wave? We will get a corrective wave after that, and a fifth wave, most likely into the 7,500 zone. So if you've been hearing analysts say that the PSEi might close the year at 7,500, that's not just a number they come up with. So there are certain measurements that lead into that number, and the Elliott wave is one of them. And look at this previous resistance back in 2022. 7,500 does make sense even on a fundamental basis if we take forward earnings, and the fact that the PE ratio of the PSEi is quite cheap, and we have to catch up sometime, right? Now, if the next sector for growth will be the property sector, let's look at our property stocks. Ali was able to break out of the 36 pesos resistance. It's now at 36.30. If it holds there, watch out for its next target range at 38.30. If we zoom out and if we expect further growth from the property sector, the potential upside for Ali could even reach 42 or 45. Now, SMPH looks like a healthy mean reversion here to the 20 EMA. This could be a good chance to buy before a potential bounce to 34.60. And given the potential further upside for property stocks, 39 to 40 range is a good target for SMPH. RLC punching through the moving averages here, but hitting resistance at 16 pesos. It's going to be choppy, but 18 pesos actually possible for RLC. But admittedly, it's not one of my favorite stocks. Mega World, remember we pointed out that this was a good technical formation and the stock could break out of the 193 resistance. It has done so. Congratulations if you were able to buy MEG. We mentioned that the target was around 2.09. At this point, you can decide to sell, partial take profits. If you see this range here, MEG can actually consolidate along this area in the next few months. Last week, AREIT was our pick. If you bought here, congratulations. There was another chance last Friday when Ali announced a private placement of 75 million shares. So far, very strong demand every time AREIT dips. Just continue buying if you need more Ali shares. Of course, RCR and CREIT still both at good levels for you to accumulate. Now, there was an influx of foreign funds into conglomerates last week. Remember, we mentioned that AC looks like it was going to break out from this flag formation. Congratulations if you were able to buy AC. Watch out for 730, which could be a heavy bear zone. Also, the market needs to digest this run up in the long-term charts. If you look at AC, there's still room for the stock to grow if the market does decide to take off. Let's go to SM, settling into 970 here so far, holding this support. It could consolidate along this range similar to what it did before. Watch out for 1,000 and see what happens there. GT Cap hitting some resistance at 722. Again, looks like a healthy correction or a mean reversion here. This could be a good chance to buy into GT Cap. Even the AEV, JGS, LTG, and the long dormant AGI conglomerate stocks are back into play. Personally, I think the run up here, a lot of investors are stuck with these laggards, AEV, JGS, and AGI, and this rally could become a chance for investors to unload on these stocks, right? So this is actually what we mean when we say rallies could be met with sell demand. Meanwhile, DigiPlus continues to recover from the sell-off here. Again, really, nothing's changed fundamentally for Plus. basketball season is also coming up. So things are actually looking quite good for Plus so far. You can also consider waiting for Q3 earnings though, because I don't think Plus's Q3 earnings will be as exciting as their Q1 and Q2 because it was the basketball off season. So we'll see, right? At this point with the market rally this broad, any stock you probably picked last week would have been a winner. So it's been quite a while since we saw a rally this broad in the markets. And we all know this saying, be fearful when others are greedy. And the greed at this point is starting to worry me a bit. For now, I'm letting my winners run and see how far they go. The markets are still benefiting from the 50 basis point rate cut, especially emerging markets. But could the markets also correct soon? Because this would give new buyers a chance to come in and help push the markets to 7,500. On to the global markets. Let's take a look at the Fed pivot here. The 50 basis point cut is actually a massive cut. And if we compare this with previous instances, look at what's happened after, right? A recession. Are we headed towards recession? Let's go back to the Fed statement, right? We have 2 more rate cuts this year. There's a recalibration of how the Fed decides on rate cuts, meaning which data point carries more weight into the rate cut decision moving forward. It is no longer inflation, and the bias has already moved towards employment numbers. So we will have to look at the labor market situation moving forward to get a hint of what the Fed will do in their next 2 meetings. GDP is still growing at 2%, which is surprising given the elevated policy rate so far. Consumer spending still healthy, still resilient. Retail sales were actually up 0.1%. PCE numbers at 2.3%. It's already quite close to the 2% target, but remember, a rate cut which will stimulate the economy could probably bring inflation back up. Let's see if they are able to hit the 2% target in 2026. Now, initial jobless claims came out at 219,000 versus 230 expectations. So the labor market has again proved that it isn't broken yet. So the next data point we have to monitor will be the third quarter earnings, which will start in the second week of October. So far, Q3 earnings of the S&P 500 companies were actually quite good. And if the economy is entering into a recession, we should see corporate earnings start to decline, but we haven't seen that yet. So aside from the yield curve uninverting and the SAM rule being triggered, there are no signs of a recession coming. So maybe the Fed could actually steer the US economy into a soft landing. The S&P 500 finally breaking out of the 5,670 resistance, hitting all-time highs, closing the week up 1.6% after much hesitation along the most traded zone before the Fed delivered the catalyst for this market breakout. However, the euphoria faded during Friday's session, but still managed to close the week in the green. At this level in the markets, again, we wonder whether we should be fearful of this greed here. This rally here is now being challenged amidst reminders that risk to growth could still lie ahead, especially after FedEx reported dismal numbers with the stock down 15%. Now, what does FedEx have to do with the economy? Now, there are certain companies in the S&P 500 that serves as a barometer for how well the economy is doing. Banks and credit card companies will give you a glimpse on consumer spending. Are they using their credit cards more? What are they using credit for? Walmart and other retailers shows consumer trends. Are they buying more consumer staple items compared to consumer discretionary items? And FedEx serves as a trade barometer. FedEx shows shipping volumes and global logistics operations that reflect broader market trends in consumer demands, business activity, and even international trade. Now, let's look at some data on rate cuts. We are actually bearish 3 months before a rate cut happens, but generally bullish 3, 6, 9, and 12 months after a rate cut. If the US economy does not see a recession within a year of the first Fed rate cut. Coming into the tail end of September, the seasonality charts still point to weaker days ahead. So far, the breakout still looks bullish coming into this week. But look at this. Are we hitting these levels in the S&P 500? Are we hitting these highs before this big sell-off happens, right? Now, going back to the charts, we will continue to monitor market structure moving forward in a typical no recession scenario. Let's look at this red line here. See how the first couple of months, so this is 0 months, 6 months, see how this red line here behaves after the rate cut. It actually goes down before it rallies in the next 24 months. But in a recessionary scenario here, what happens to the market after the rate cut? It actually rallies up, sucking investors in before the big drop, a consolidation, and another big drop happens in the next 6 months. So the next month will show more indicators of where the S&P 500 is headed in the near future. So we'll see. That's it for this week. Please like this video if you found the information useful. Please subscribe to the channel for more updates. And again, good luck on your trades. Please manage your risks accordingly. And I'll see you again next week. Bye-bye.